Good morning. Welcome to a Jeff for Banks video blog. I'm off to a slow start in 2020 due to a little vacation time and catching up on some things, so I apologize to my readers. This is a follow-up blog to a TKG Perspectives missive that I sent out a couple weeks ago. I'll link that in the post, but in that Perspectives, I opine that the cost per account, the operating cost per account of business checking accounts, was demonstrating a positive trend due to pretty decent production on behalf of community banks. In other words, the origination resources were firing on all cylinders, which means that the average operating cost per account was trending downward. And long term, really that's what all of your products should do. But unfortunately, if I look at the other product groups other than residential real estate lending, which is also enjoying some solid volumes due to the interest rate environment, and therefore the cost per account of a residential real estate loan long term has been trending downward. All other account categories, commercial real estate, business loans, consumer checking, money market accounts, all of those costs per account have actually been going up. And I want to give a couple ideas of how banks can manage this process, because long term, if you actually are realizing economies of scale, the operating cost per account category should go down, and therefore your efficiency ratio should also go down, all things being equal, and your expense ratio, your operating expense to average assets, should also go down. So in other words, if you're able to successfully drive down the cost per account of your different product groups, you should also be improving your financial performance of your bank, making either more available for technology investments, personnel investments, drop to your bottom line, instead of squirreling away resources on non-value added things. One reason we see that cost per account go up is a significant amount, probably 70% plus, of resources are dedicated towards the origination of a product. So if you open up a money market account, resources go into place to do the address check, do the know your customer checks, etc., that go into originating that money market account, in addition to all of the effort that you get to bring that customer on board. And we don't see a lot of variable cost in that structure. Now, I have talked about in a past Jeff for Banks post that we have to rethink branch staffing and put higher level individuals, breadwinning pay in banks. But what I didn't say is that all has to be fixed compensation. So you could have this high performing branch manager that might have, say, a $70,000 salary, but the potential to earn another $20,000 to $25,000 in variable comp. So therefore, when volumes go down and the branch isn't performing as well, there's a higher proportion of variable expense that would also naturally go down. And if things go up and things are going well, of course, that'll go well for the individual as well. So I think on the origination side, this could work for lenders. Anybody who's on the frontline staff have a higher proportion of variable compensation, because if you look at how, I'm not suggesting that bankers do it like residential lenders do it, where it's almost all variable compensation, but we can learn a little bit that a lot of variable costs in the residential real estate goes down when volumes go down. So therefore the cost per account tends to go down. I think that in the other side of the bank, the commercial lending, the branch banking, we could have a higher proportion of variable compensation. Then the other side of solving this, why are operating costs per account going up, is the significant amount of resources in support centers that can become more efficient through the use of technology. We still see a significant amount of manual processes and spreadsheeting going on in the back office, mostly due to lack of knowledge of what might be out there to do things better. People spending extraordinary amounts of time balancing accounts, etc., that can be performed via robotic process automation, but we're still doing it manually, and we're dragging our feet on moving quickly. So I think that the number of loan accounts per loan servicing person should go up if we're successfully automating. I think the amount of core deposit accounts per deposit operations person should go up if we're automating, and therefore we're realizing those economies of scale in the back office. I think we're very slow moving in terms of getting those economies of scale into support functions. So if we are going to be successful in actually achieving economies of scale in the industry, delivering either better financial performance or making available greater amount of resources for technology or human investments, we need to look at, first and foremost, making more of our cost structure variable, and then secondly, looking at the processes we have going on in support functions and delivering a culture of being able to do more with less in support functions. So those are my 2 cents worth in how to drive operating costs down per account. Leave a comment on what you think.